Kwame Owino is the Chief Executive of the Institute of Economic Affairs, is joining us now on the program. So, Kwame, let's start with your broad impressions of the rate hike that has been implemented this week. The central bank says, look, we're aiming to bring inflation back into range by September, but what do they need to do to get it there?
Well, I don't know, because let's just start with the fact that his predecessor, Kwame Owino's predecessor, said very clearly that there are some elements of inflation that are completely outside the control of monetary policy, and I think he's right. So if you put that together with this response, one, it's out of cycle, and two, it's unprecedentedly large. Something like 7 years or so since we had something this big, suggests to you that his interpretation that there's need to more aggressively fight inflation, coming from obviously recent changes in the finance bill and all that. I don't know that there's much, except that my expectation would be food prices were going to moderate as soon as the harvest comes in, and this is a season within the next 2 months. As greater harvests are recorded in Kenya, we'd see that price. So in my view, it was a question of patience and looking at it, but it seems like Dr. Kwame Owino and the Monetary Policy Committee have a different view.
Indeed. And this morning, the governor also had an interesting argument. Essentially what we heard him saying there, the rate hike might help to support the shilling, but there's an interesting element of contradiction there, because you've got these huge lingering problems in moving capital out of the country. MSCI mentioned it last week. So if on one hand you're saying, yeah, we want to attract capital by raising rates, but yet investors know they're going to have problems moving capital out of the market, this isn't really going to work, is it?
Well, I don't know. Unless he relies on that, of course, it's clearly, yes, you're cutting from different, doing one thing else and undermining it in the other way. So yes, that's true. But in terms of the rate cap, I think they're also chasing that, even though he said it's a secondary intention. But I think they're chasing that as well, because they've seen that the US has suggested, some suggestions of the US show that the tightening is going to tail. And so his expectation is that if we have very aggressive movements, 100 basis points all at one time, will suggest that to whoever is thinking about rather try to equate and provide some competition for funds that would leave Kenya to go to the US, for instance, or somebody else would see Kenya as more attractive right now.
Indeed, it's going to be interesting looking at the inflow numbers, especially in the capital account later on in the year. Let's move on to the Finance Act, because that was one of the things that he said, we need to tackle some of the secondary effects from this particular bill. What sort of inflationary measures are you expecting to see, or rather inflationary impact are you expecting to see from the Finance Act of 2023?
Well, I think in your clip, the governor stated that, and I think you reiterated it as well. If the prices of fuel, specifically through VAT, go up, then definitely the knock-on effects, second order effects in terms of prices of transportation, prices for commuters, and obviously generally fuel prices, which are also used in generation of electricity, would show over time, and it would. So in the first case, that's just one of the very first ones that's pretty clear about that. The second is it is possible that because of the new deductions that would come in for wages, whether it's for the levy that's supposed to pay for housing, there might be demand from actually workers who are organized in unions to actually demand higher wages in the next few months, perhaps. Whether it comes forth or not is a different matter, but that kind of pressure would actually lead to wage pressure going up, and if that happens, then obviously it has a knock-on effect as well on inflation.
Let's actually talk about that particular housing. Well, government would like to frame it as a housing levy, but in actual fact it's a housing tax. It's one of the most hotly contested parts of this law. But from where you sit and the analysis you've done on the Act, what are the pitfalls on implementation, since it comes into effect really from July? But as things currently stand, there's virtually no proper oversight. There's no legal ring fencing of the tax proceeds.
Precisely, and I think that's. It's a very cheeky thing, because yes, it's as if we are, as we were discussing today. Look, let's have the shoes on today, and then of course we put on our socks sometime into the future. So it's very clear that this is a lot of money. It's quite tons of money that's going to go in with compliance being nudged with some suggestions that obviously a default would actually generate penalties. So obviously the money is being collected. The mechanism for ring fencing it is not there. So it will be as if the money will come in and thereafter it will be. So, and knowing the pressures the government has right now for payments, basically the fiscus, I think some of that money might be diverted very quickly. And any possibilities of its recovery in the next year or so, I think it's not going to happen. So yes, it's going to serve as a fund that's available, and a lot of things that are not housing specific will be charged on it. So I think it's a bad move.
Indeed. And looking at taking all of these actions in totality, on one hand, you've got taxes going up. At the same time, you've got the housing tax that has now come in. It's taking a bigger chunk out of a diminishing pot of employee income. There's a proposal now to also raise contributions on the National Hospital Insurance Fund as well. In general, that seems like a collection of policies designed to make things a lot more contractionary.
Certainly. I mean, especially because one of the things that's going to happen is for the NHIF, which is the National Hospital Insurance Fund, which is basically an additional 2.5%. If that happens, the amount that will be paid will actually displace private sector insurance funds. So obviously, that has effects on whether those funds will maintain their business, their revenues, obviously, and wages. So one of the expectations here is definitely payrolls, unemployment is just going to shrink, or at least it's not going to grow at the anticipated rate, in as much as, of course, the governor today was talking about growth rates being healthy.
All right, one last question for you, Kwame. One of the things that the governor also spoke about a fair bit was essentially this premise that Kenya's government is going to stay on this path towards fiscal consolidation, reducing the fiscal deficit from highs of like 8.2% going down all the way to around under 4%. Do you think they'll actually pull it off?
Sure, they will, because if you look at what is declared, and we have a supplementary budget coming in now for the last financial years we've started on, that's just a signal of serious fiscal indiscipline. And if it's carried down into the future, I think those numbers will actually be just for the purposes of passing the budgets. As soon as that is done, the spending will continue as it is. So that's the first. The second is just the behavior was, you'd expected that obviously fiscal consolidation would show some cuts or even some caps, but government spending is just going up as well, and still growing at faster rates than revenues are growing, so suggesting that there'll still be pressure on the deficit.